What's going on, guys? My name is D. Anthony with Evolution Traders. In this video, I want to do a little bit of a top-down analysis on the NASDAQ 100. I want to kind of get ready for this week. I would like to, have some type of market bias, right? Now, again, we never want to marry, right? We never want to marry, or this should be the finger. We never want to put that wedding ring on our bias, but we do want to have a good overall feeling of what can happen, right? And I'm a big believer in we need to make sure as a day trader that one, we don't marry the bias that we come into the market day with. Two, we have some type of, if this happens, I need to be ready to go long. If that happens, I need to be ready to go short. Now, if we look at the daily chart that we're looking at here on the screen, we're going to be looking at three types of supply and demand zones. The first one being the 20-day moving average, which is the white line you see on the screen. The second one being the 50-day moving average, which is the red line. And the third one being the 200-day moving average, which is the granddaddy of them all. Now, if we kind of go back to July the 11th, we put in highs of 20,983. Okay, so 20,983 was those highs. We pulled back, but I want to make something very, very clear. This trend, okay, this downtrend started to get validation once we lost this 50-day moving average, and that was on the 24th of July. Okay, so even the pullback here into the daily 20-day moving average, and then we had a little bit of consolidation, this was still healthy. This is still healthy for the market. We could have just pulled back, tested this 20, consolidated, and then reclaimed the 20-day moving average and then make new highs. Once we lost the 50-day moving average, you can see we went into a distribution cycle. Okay, distribution is where price starts to accumulate, and then you have a little bit of a bidding war going on between buyers and sellers to see who's going to take control of the charts. And that lasted for 1, 2, 3, 4, 5, 6 days before finally losing those lows we put in below the 50-day moving average. Now, the next soft landing spot that we put in was at this 200-day moving average. This is very significant. A lot of you guys remember this day. This is when the market was, gapping down over 1,000 points, right? Very, very significant. A lot of people were calling for, this is it, market's going to crash. Just throw the baby out with the bathwater, mortgage the house, sell the kids, do whatever you need to do, go cash. And then lo and behold, 2 days later, we start this a little bit of a rally, and we've been on a 7-day rally now, essentially 6-7 days of nothing but straight green. Now, have they been the most easiest days to trade? Absolutely not. No trading day is ever easy. Okay, some days it's a little bit more easy to find a potential setup where you can make some money and then call it quits, but no day is easy, right? The market never really makes things easy. Okay, if it was, then you, me, and everyone else who does this would be multi-millionaires because it's easy. Okay, it's not easy. Okay, I'll be the first one to tell you that this business is not easy, but it can become a little bit more comfortable if you get familiar with recognizing different patterns and price action changes and swings, and being able to manage your risk a little bit better and your emotions a little bit better. Those things do become a little bit more simple. The game starts to slow down, right? The game speed starts to slow down. The candlesticks don't move as fast. It's a lot easier to manage a loss once you do take that losing trade versus going on tilt and revenge trading. Those things do slow down a little bit. But as far as predicting where the market's going to go on a day in and day out basis and being right, 90, 80, 100% of the time is impossible. So what we're looking at here, and I would like to actually put a fib, okay? I'd like to actually put a fib from the highs, from the highs down to the lows, okay? So if I was to drop a fib, we're at about a 61.8% retracement, okay? From absolute high to the absolute low. Let me tell you something. Normally, on any type of dead cat bounce, or any type of pullback when the market is screaming higher, you're looking for that sweet spot for the move for the short term to go the other way, at least for a little bit, at least for some type of back test, at least for some type of pause, at least for some type of consolidation. And normally that sweet spot is anywhere between the 50% and 61.8% retracement. Okay, so as it stands, if I show you guys this daily chart and we look at the candlestick that printed on Friday, it's a little bit of a pause candle. It's a little bit of an indecision candle. Okay, does that mean that the market does not reclaim the 50-day moving average and push all-time highs? Absolutely not. But what it needs to do is get you to start thinking about the possibility of maybe there's a pullback, maybe there's a short pause, maybe there's a little bit of time of distribution where we rest, maybe there's an opportunity to play the downside to make a little bit of cash until we figure out if that bottom is going to be the bottom. Okay, this bottom that we had down here, is this going to truly be the bottom? That 17,300 area, is that going to be the bottom? We don't know. Okay, we've had a tremendous bounce. What I personally would be looking at is I'm looking at the candle from the 16th and I'm looking at the highs and lows. For me, there's really no trade until we take out Friday's highs or we lose Friday's lows. Anything in between, absolute junk. Now, am I saying that you can't trade it, can't find a scalp for 5 points here, 5 points there? Absolutely not. But what I'm saying is that you're not going to get those true moves, those true follow-throughs until we take out a previous day high or low. And when we take out a previous day high or low, you want to make sure there's enough space in that trade to the next area of supply or demand, depending on if you're going long or short, to be able to make some money. Now, there's plenty of room on both sides, because obviously if we take out the highs over the 50-day moving average, that's also taking out this prior swing high here going back to July the 31st as well as August the 1st. So we do got a lot of room back over the 50-day moving average, and that would kind of put the bulls back in short-term control, and that's what you want to see if you're a buyer. But if we do lose the lows, and I'm going to give you the price here, 19,447. If we do start to lose that, we've got room all the way back down to 19,000. So we're looking at anywhere between 300 and 400 points to the downside that we do have room. And that's more than enough money to get in there and take a few trades and make some cash. So what I'm looking for going into this week, today being the 18th, tomorrow market's going to open, or tonight actually, but on the 19th on Monday, what I'm looking for is previous day high, previous day low. And if that confirms, it doesn't matter what time. I don't care if it's in the pre-market. I don't care if it's after lunch, before lunch, whatever. When we confirm a previous day high or low on this chart, the way it's set up, now it's not like that every day, but at least for right now, if we can confirm a previous day high or low, I'm going to be all over that. And again, what you're looking for is in terms of price target. I'm giving you the bigger price targets. Like the bigger price target to the long side would be back up towards 20,000, and the downside would be somewhere close to around 19,000. Those are the bigger price targets. Okay, but use some common sense. We're not going to try to catch the whole move. We just want to be a part of the move for just a little bit to be able to get in there and make some cash, right? Again, as a day trader, as a scalper, that's all you're looking to do, is you're just looking to get in and make a little bit of cash where you fit in, but you want to be right on that bias, okay? You want to be right on that analysis. So that's the only thing I'm going to be focusing on. Now, if you don't get your 20 SMA play, you don't get this play, you don't get these particular setups that you trade on an everyday basis, that's fine. That's fine. Right now, the market is acting very funny. Okay, it's trying to figure itself out, guys. We got a lot of things going on. You know, interest rate cuts. You know, things going on in the world, on the other side of the world, with different countries and wars. And I don't even want to get started into that. It's an election year. It's the end of summer, right? So we're going to get a lot more volume coming back into the market. Again, for those of you guys that are new, you've heard me talk about summer trading. You're not familiar with summer trading. Guys, this is summer trading, right? Lower volume, big expansion moves, right? Like you want to see a lot of volume and less expansion moves, okay? You want things to be orderly. Things have not been orderly. Volume is a little bit more dry in the summer, okay? There's a little bit lesser volume. So when you have lesser volume, it's taking the like not as big a player to move and expand this market up or down, okay? That's all summer trading is. And why it's like that, guys, you have to think about this. When you're a big time banker and you're a big time trader and you're a big time firm, a lot of these kids are off school, they're doing things, they're on vacation, they're in the Hamptons, they're in Europe, they're overseas. these things are not secrets. They're not secrets. Okay, people get away from the charts. Again, I'm not talking about your average retail trader, because we seem to gravitate more towards the charts in the summertime. And things have definitely changed since the pandemic and since COVID. There's a lot more market participants. So you're kind of seeing volume kind of just spread out a little bit more, neutralized throughout the year. But pre-pandemic, pre-COVID, you would definitely see those market cycles and those market shifts. And again, until I see years and years, right, at least 3, 4, 5, 6 years where markets seem to trade the same for 12 months, then I'm going to sing a different tune. But for as long as I've been in this business, summertime trading is always a little bit more drier, where you do get these weird, unexpected moves, these big ranges in the day, right? So again, I'll leave that for another video. But what I'm looking at here is Friday's high and low. Okay, it's very, very important, because this is the second test here, 2 days back to back. The second test where we're testing this 50-day moving average. And this is a big spot, because the last time that the buyers lost this point of control, they really had a hard time, and we've been trading under it for almost a month now. So we've been trading underneath the 50-day moving average for almost a month's time. The sellers still can take control of this chart, and just because we've had a 5, 6, 7-day rally does not mean that they can't put this thing back down towards $17,000, $18,000 within a week. It's entirely possible. So we need to be ready for that move if it does happen, and not so gun shy if it does happen. So many people are looking for the long right now, but you're not ready for the short. Or some people are so interested in the short right now that you'll miss the long, and the long will just continue to go. Okay, so if the long continues to go, for example, if we gap down tomorrow, let's say we open up the markets on Monday and the market's down 150, 250, 300 points, then whoa, maybe we pull our foot off the brakes a little, off the gas a little bit here, and we start to say, well, maybe if there's an early trap, an early flush, then we can get in on the bounce, right? Same thing, if the market gaps over the 50-day moving average, I would be a little bit more hesitant to go with those longs right out of the gate, because I don't want to get trapped. I'm going to look for the rejection on maybe a 4-hour or 1-hour time frame, and then see if I can pick that spot to get that short back down into support. Again, if you're a long-sided trader, then yes, you want to buy the dip. So you're going to go ahead and want that dip to kind of come in. You're going to avoid the short, and you're going to look for those small pops off of those demand zones. So there's a lot of ways to trade this market right now. There's more than enough, I guess, pie to go around, right? So again, if you guys enjoyed this video, make sure to like, comment, and subscribe. Also, if you would like to trade with me, that link is down in the description box below. If you're looking for a prop firm where you want to add and scale more capital, Apex Trader Funding, I work with them. I'm funded with them. I'm also working on evaluations constantly. Right now, I'm at 9 funded accounts. I'd like to get that up to 20, right, which is their max allocation before the end of the year. I'm slowly working on them. Again, I could try to aggressively try to go out there and pass more evaluations right now, but I like to normally try to work on between 3 and 4 at a time. And I trade those very aggressive, and I trade those very fast. So I trade them completely opposite the way I trade the live funded accounts. But again, I can make a video covering that as well. If you want to know the difference between those two, just let me know in the comments. Hope you guys all have a fantastic trading week. Again, we are back. We are live. Let's crush the markets this week. Let's make some money. If you have questions, ask them in the comment section below. More than likely, I'm going to get to a video. Or if you would like to work a little bit more personal with me and the team at Evolution Traders, then definitely join, right? Make the investment into yourself to continue your education, not only your education but your networking. Okay, without the right network, you know, what's a hammer without the person who's going to swing the hammer, right? You know, what good is a blueprint if you don't know how to read it? So again, it's not what you know, sometimes it's who you know. At the end of the day, I'll see all of you guys on the inside.